I think gold is intentionally ignored by the mainstream media. It's intentionally ignored by the too big to fail banks and the private wealth management teams because gold is an absolute threat to the US dollar. It's an absolute threat to the government. If the gold price rises too high, that means your fiat money is a joke. It's an open joke. And it's not in the government or the bank's best interest to see gold fully understood across the board. To me, that's very simple. But yet now, because of alternative media, because of political headlines, because of the Trump elephant in the room in the China shop breaking, gold's suddenly being discussed. For better or for worse, it's being discussed.
What makes gold's move to $3,000 per ounce particularly interesting is that it's just another level in what analysts see as a much bigger rally. In the last few weeks, we've heard from several analysts who expect gold to reach its all-time inflation-adjusted highs set in January 1980. In the last 3 years, the price of gold has risen around 60%, with a 30% increase in 2024. Numerous recent published opinions have suggested that the price of gold will continue to rise due to underlying economic factors like inflation and geopolitical unrest. Some experts are ruminating on whether all this gold rush activity may be a precursor to revaluation. Renowned hedge fund manager Matthew Piepenburg describes gold as a wealth preservation tool, comparing fiat currencies to melting ice cubes. He notes that central banks have tripled their gold purchases since the U.S. weaponized the dollar in 2022. However, a central point of Piepenburg's analysis focused on the Comex, a major commodities exchange. He described a dramatic outflow of gold, raising serious concerns about the stability of the system. What we saw in just the last week was $21 billion of gold going out of the Comex, Piepenburg revealed, emphasizing that this is a massive indicator. That's a rotten leaf of a bigger tree symptom. Meanwhile, Piepenburg connects this trend to the BIS and BRICS nations, which are shifting from U.S. debt to gold. Chinese holdings have dropped to their lowest level since 2009, falling $57 billion to $759 billion in 2024. However, a Financial Times report notices that these figures may not give the whole picture. Some have been transferred to securities depositories, such as those in Belgium and Luxembourg. According to Piepenburg, political figures like Donald Trump have brought gold revaluation and Fort Knox audits into mainstream discussion. Regarding Trump's discussions, he believes these are attempts to address deeper economic issues. However, he warns that reversing the crisis may already be too late. Now, we present the clips of Matthew Piepenburg's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
When you're talking about revaluing gold or doing an audit on Fort Knox or the too big to fail banks, those are things that are making the headlines because politically Trump has been dropping these things in the media. Mm-hmm. Of course, it brings it to the headlines, which is both kind of charming and exasperating at the same time. There's a lot of misunderstanding. It's fascinating for me, who's been looking at gold for years, and for our company that's been doing it for decades, to suddenly see all these gold experts popping up and saying, I told you so, when just 4 years ago, when gold was 1,600, they didn't care about it at all. But it always is ultimately good for people, whether they're very critical of gold or very positive about gold, to see it making more of a mainstream headline attention. Because look, gold doesn't go in a straight line, and certainly in the last 25 years has outperformed the S&P, et cetera, et cetera. But there are periods of years where gold did nothing and the S&P outperformed. But traditionally, when there's recessions, the outperformance of gold is pretty obvious. Not every time, but pretty obvious. And so just having that come up to the equation again, having that be discussed again, I think gold is intentionally ignored by the mainstream media. It's intentionally ignored by the too big to fail banks and the private wealth management teams because gold is an absolute threat to the US dollar. It's an absolute threat to the government. If the gold price rises too high, that means your fiat money is a joke. It's an open joke. And it's not in the government or the bank's best interest to see gold fully understood across the board. To me, that's very simple. But yet now, because of alternative media, because of political headlines, because of the Trump elephant in the room in the China shop breaking, gold's suddenly being discussed. For better or for worse, it's being discussed. There's a lot of hype. There's a lot of nonsense, whether it's about Scott Bessent's holdings or how much gold Fort Knox really has or the banks really have. All that's kind of fog. But what it is it's bringing attention back to the fact that gold matters. This analog pet rock isn't just an outdated thing that's been money for millennia. It will continue to be money. It's fascinating. They'll talk about the importance of revaluing gold, which is, again, a guppy solution to a whale of a debt problem, or the auditing of Fort Knox, which isn't even where all the gold would be. It'd probably be in the basements of a lot of the New York banks. But you get past those headlines, it's amazing something like the Comex, where you're seeing 21 billion of gold standing for delivery. This is not a gold reserve fund. The Comex is a credit exchange. It wasn't supposed to stand for delivery. We're seeing record levels at 4 times the pace of last year of counterparties wanting their gold out of the Comex. To me, that's the far more important story about gold. The stand for delivery, this open interest on the futures market on this New York exchange is hitting unbelievable levels of outflows. And that implication is not about price arbitrage between New York and London. It's not about tariffs with Trump. It's about counterparties want their physical gold. Why? They don't trust paper money anymore the way they used to. They don't trust the U.S. Treasury the way they used to. They don't want the U.S. dollar the way they used to. That is the real headline, and that's not making the front and foremost on the minds of most retail investors. For those who've been tracking gold for years and understand the price fixing on the Comex, this is nothing new. But for me, that is the headline of the year. This outflow out of the Comex is fascinating what its implications are. But it's all part of this broader narrative that the BIS told us in 2023 and the BRICS have been doing since 2022. The world sees gold as a better strategic reserve asset than the US 10-year or the dollar. That is not a gold bug case. That's history. And why do they prefer gold over these former sacred cows, these former tier one asset? Because those countries are too far in debt and their credit is no longer as good as it used to be. And they're outstretched. And they're in that fourth stage of an empire where they're too spread out, too thin. And that's why Trump is trying to cut spending. And that's why Trump is talking about revaluing and auditing gold. But the real problem is it's too late. We're already in this crisis now. We have to make drastic changes. We need peace, not war. We need to cut our spending. We need to weaken the dollar. We need to bring our debt to GDP down. We need to reshore jobs. That should not be left versus right. That should be common sense to every American or Canadian or every citizen of the world in their own countries. But sadly, it's still hard for people to grasp that. And, yeah, to your question, it is nice to see gold finally reaching its head above the fog a little bit and being discussed. That doesn't mean gold goes in a straight line. It doesn't even mean that gold makes you rich. Gold just keeps you from getting poor because your fiat money, your Canadian, Australian, or American dollar, your euro, your Swiss franc, your yen, your ruble, more so in the West, is a beautiful ice cube that's just melting right before your eyes in purchasing power. You add on to that the invisible tax of inflation and then income tax. I'm surprised people can get through the day with all the things killing their wealth every day. So gold is just a protective preservation instrument. Yes, its price moves are incredible. I'm very happy for it. But I don't look at the price moves. I just know it holds its value better than fiat money. And the rest of the world does too. And since we weaponized the dollar in 2022, central banks have been buying gold at 3x the volumes they were pre that. There's a reason for that. Follow the hockey puck. This isn't a gold bug argument. This is history happening right now.
Seasoned analyst Matthew Piepenburg critiques Janet Yellen's strategy of issuing short-term debt to manage long-term yield curve pressure, calling it a weak temporary fix. He argues that the U.S. lacks viable financial options with mounting debt, dwindling Treasury buyers, and growing global de-dollarization. In the U.S., stronger than expected labor market data put upward pressure on Treasury yields early in January. However, longer-term data still pointed to some softening in the labor market, indicating a trend towards normalization, and Treasury yields fell in the latter half of the month. Speculation that Trump would pour stimulus onto the nation's expansion and keep upward pressure on Treasury yields is being rapidly swept aside less than 2 months into his presidency. Instead, traders have been piling into short-dated treasuries, pulling the 2-year yield down sharply since mid-February, on expectations the Federal Reserve will resume cutting interest rates as soon as May to keep the economy from deteriorating. While shifting away from U.S. Treasuries, Piepenburg views gold as part of an inevitable historical cycle. He also mentions Scott Bessant's blunt acknowledgement of the debt crisis, contrasting it with previous administrations' denial of financial realities. Let's get back to the interview.
I mean, that the Yellen playbook of issuing from the short end of the yield curve to, take some of the pressure off the long end of the yield curve, it was a Band-Aid solution. It is a kind of a form of yield curve control in an indirect way. And, the playbook is pretty pathetic for the U.S. right now. We don't have many options. We could try the Yellen option of issuing more short duration, but that rolls over really quickly, and we don't have a lot of buyers at the Treasury auction. And more importantly, it's a guppy solution to a whale of a problem. Because when our military spending, our entitlements, and our interest on debt is 140% of our tax receipts, issuing from the short end of the yield curve is not going to solve that problem. So that's not really a good option. The other option is we could default, but that's not going to happen. As long as you have a money printer at a central bank, you're not going to default. Certainly the U.S. is not going to default. We can't do the Yellen playbook, just issuing from the short end. We can revalue gold and get 800 billion out of that. We mark $42 certificates to market value, but that's not going to solve the debt problem either. Even Doge isn't going to offset the debt problem. What are our options? They're as old as history itself. Debase your currency, inflate your way out of debt, negative real rates, financial repression. So your questions all come back to the same answer. But yeah, the short end of the yield curve, issuing short duration treasuries, is not going to solve our TGA account. It's not going to solve our government bond crisis. And it's not going to solve the fact that a lot of these trillions of dollars worth of bonds are rolling over, and there's less and less buyers at those treasury auctions, and more countries trading outside of the US dollar or net settling in gold instead of US treasuries. That's not a gold bug case, folks. Let's get past that. That is just history happening as we speak. So the treasury market, the bond market in the US in particular, because it's the home of the world reserve currency and the sacred 10-year US treasury, which is the only other tier one asset by the Bank of International Settlements, that is not the same bond market that it was 10 years ago. And that treasury market is everything. If you understand how important it is, the Fed's mandate is not unemployment and inflation. The Fed's mandate is to make sure something or someone buys our US treasuries, because we live on credit, we live on debt. And what's happened since 2022 and the war in Ukraine and the weaponization of the US Treasury and the US dollar is that more and more countries are reacting against that. They're moving away. The hockey puck is going away from the US dollar. Again, it doesn't mean the ruble or the yuan is the world reserve currency and the dollar disappears. It just means a repricing of the dollar. Things are changing. The dollar is not what it was in 1990. America is not what it was in 1990. Geopolitics are not what they were in 1990, because all of these nations are collectively broke, and all of these nations are looking for different life preservers outside of the US dollar. Gold is one of them. Investors are looking at different life preservers besides the US Treasury or the US stock market. Gold is one of them. This is just open and obvious to those who are paying attention. It should not be a gold bug case or an anti-American or anti-European case. It's just history. I know a lot of people who know Scott Bessent. I've seen him, and he's refreshingly smart. Compared to Yellen, I'll take him all day long. He's also a big gold investor, but that's neither here nor there. But he understands history, understands gold, he understands money. He's made a lot of money on Wall Street. But unlike Yellen, he came into this office very blunt and very open about what a debt crisis we're in. And that in and of itself is very unique. Again, when I look at the difference, whether it's the Department of Justice, whether it's the National Security Association, whether it's National Intel, or whether it's the Secretary of the Treasury, the amount of candor, I'm not saying they're all Santa Clauses, they're all going to solve all the problems and everything's kumbaya, but the amount of candor and reality speak is so different than the last administration. Again, I'm a former Democrat, so this is not pro-Trumpism. I think there's a lot of Democrats who I've talked to can't deny that there was something asleep for the last 4 years in D.C. It was yawningly, dangerously bad. But again, that will upset half the audience. I get it. But Bessent understands that we need to cut down our debt to GDP. We need a weaker dollar. We need to reshore jobs. There is no easy solution. He recognizes that the BRICS are a threat. Trump recognizes that the BRICS are a threat, but they think that the U.S. is the biggest sucker. The BRICS countries would think they're the bigger sucker. There's a lot that I don't have the answers for, and that Trump and Bessent don't have the answers for. The BRICS aren't going to go away and bow to tariffs, etc. So there are a lot of things that are not going to be clean and that Trump and Bessent can't solve. But what I do find refreshing about Bessent is he at least admits that we have a problem.
Analysts have been anxiously waiting for this run to $3,000 since the start of the year, and some anticipated that this key level would trigger some profit-taking. However, market sentiment remains fairly bullish, and many analysts are increasing their price targets for the year. Suppose global markets and central banks revalue gold as a superior reserve asset. How might this reshape the global monetary system and the future of the US dollar? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.